All right. Today we are going to be looking at a question, a very quick question. Okay, so that we don't waste more time. Quick question that will help us understand how to account for VAT. Okay. Remember. So let's say accounting for VAT. Let's call it that way. Okay, so that's from an accountant's perspective. So how do you account for it when it comes up? In the course of what business. All right. So VAT represents value added tax. Okay, so value added tax is the tax imposed on VAT products. Okay, so VAT products are products or services, okay, on which the value added tax rate is expected to be imposed on the value they generate from the point of manufacturing, okay, to the point of consumption. Okay, so there are some products, or there are products. As a matter of fact, every product, okay, generate some sort of value as they would move from the point of manufacturing to the point of consumption. So what the revenue service is saying is that at each stage of movement, the value generated, okay, should have a particular percentage remitted to the revenue service. Now remember that your product at the point of manufacturing, after that it moves to, let's say, the wholesalers, right? Then let's say it moves where? To the retailers. Then from retailers it moves to where? To the consumers. So ultimately, the consumers are the ones bearing the final cost. So what I'm actually saying here is that the manufacturer, after producing, sells to the wholesaler. So let's say the manufacturer buys a product, let's say for 100,000, okay, and then after buying, it could be raw materials, okay. So after buying it, he maybe with the use of innovation processes and some various things put in place, he was able to change the product to something that can be sold. So in doing that, he gets a final product. He now sells to the wholesaler at a cost higher than this. Let's say he sold it for 150,000 to the wholesaler. Now the wholesaler also gets it, does some sort of innovation, okay, add some value, and then moves it to the retailer. Let's say at 200,000. Now the retailer gets it and then add some value to it, sort of maybe innovation as well, processes and various procedures to make it more valuable, moves it to the consumer, let's say at 250,000. Now if you watch in terms of value or figures, between this guy and this guy, there is a value of 50,000. Between this guy and this guy, that's the wholesaler and the retailer, there's another value of 50,000. And then between this guy and this, there's another value of 50,000. Okay, so what we are saying is that these values in figures, we should add what, or apply a percentage based on what, on the recommendation of what, of the VAT Act, and then remit it to who now? To the inland, or let's just call it the revenue what, service. Now in Nigeria, the collection of VAT is the responsibility of the, what, the Federal Inland Revenue. So what we're saying is that every VAT that charged on what, on vatable products, are remitted to who? To the Federal Inland Revenue Service. So the point I'm trying to make here is that in this chain of distribution, at each point that there's a value addition, okay, FRS is saying we want a percentage of each of this what, value. So from this guy to this guy, there's what, a value percentage here. There's a value percentage here. There's a value percentage here. So in this movement, from this point to this point, there have been 3 addition of what, values at different what, stages. So we're saying that each stage of value must be taxed, and that tax must be remitted to what, to the Federal Inland Revenue what, Service. Now this, we're talking from the perspective of the taxpayer now, sorry, the tax collector now. So when it gets to the perspective of the taxpayer, then we have to, you know, understand where to place the accountant. But for now, we're talking from the perspective of the what, of the tax collector, which is the Federal Inland Revenue Service on behalf of the government anyway. Now you must understand that there are some terms used. There's something called VAT output. Now when you say VAT output, we're saying that when you sell your product, you should apply VAT. So the VAT charged on sales made, that is when you sell vatable products, the VAT charged is what we call VAT output. Now, you can also purchase vatable products. So from the perspective of purchasing now, you know, of course, you're dealing in vatable products. You're going to buy vatable products and sell vatable products. So from the point of purchasing vatable products, you also what, get charged VAT. So you pay VAT there. So that one, we'll call it VAT input. So what we're saying is that at every point, there's a VAT application. So it's either you are paying the VAT or you are charging the VAT for collection. So when you sell and then you what, apply what, VAT, we call it VAT output. When you purchase and apply what, VAT, we call it VAT what, input. So what am I saying? If somebody is selling something to you, that means you're purchasing. If it's a value product, that person will add VAT to the invoice that is selling to you. So that means you're going to pay for that product. So as you're paying for the product, you're also paying the VAT. So that VAT you're paying on that product you purchased is called VAT input. Then, but when you're not selling, you're also going to charge VAT. When you charge VAT, you collect it from them. That one on sales is called what? VAT output. So let's say you purchase the product for what? 100,000. So if you apply VAT, the VAT rate now in Nigeria is 7.5%. So you're going to have to look at your, your VAT Act, and then also look at your Finance Act. I think the one that was signed in February 2020 by the President. So that will also help us understand, the shift from 5% towards 7%. So it was previously 5%. Then the Finance Act that was signed, or the bill that was signed into Act in 2020 February, moved it from 5% to 7.5%. So let's use the current rate, which is 7.5%. So we're saying if you're purchasing a product at what, 100,000, you're expected to what? Pay, not even expectation, the guy is going to send his invoice and then apply what? 7.5 VAT. So what does that mean? It means that what? If you're paying for the purchases, you're going to be paying, 7.5%, okay, of what? 100,000, okay? That is what? 7,500. So that means you're going to pay what? Excuse me. 7,500, okay, plus 100,000. I'm just going to pay 107,500, right? So the purchase is meant to be 100,000, but the guy selling to you that you're purchasing from is applying 7.5%. So what it means is that if you're not paying 100, you're paying 107,500 as the purchases. Now this 107,500, okay, is the total cost you're paying for the product that you purchased. So basically, in this 107,500, you have 100,000 as your purchases, and then you have what? 7,500 as your what? VAT what? Input. So this means that you have more like a credit. Okay. Now when you sell, you're going to sell at a what? At a value. So let's say you're selling at 250,000. That's the final consumer gets at 250,000 naira, and then he also pays 7.5%. So that means what? You're paying what? You're paying 2,687.50. So what does that mean? The VAT there is what? 0.075. Okay, times 250,000. That's what? 18,750. So we're saying that this 250 is your sales. Then you have this 18,750 as your VAT output. So at the point of sales, okay, you charge VAT. At the point of purchases, okay, you pay VAT. So what we're saying is that the VAT output will be compared to the what? VAT what? Input, to know the net difference that you pay to what? The Federal Inland Revenue what? Service. So based on this scenario now, you can see that the VAT output here is 18,750. The VAT input is what? 7,500. So what's the difference? We say 18,750 minus what? 7,500. So what do you have? I have what? 11,250. So this is what you're going to pay to the what? Federal Inland Revenue what? Service. So it means at every point in time of remittance, you must compare your what? VAT output with your VAT what? Input. So from the accounting perspective now, we can say your VAT output is more like a what? It's more like a liability, because you sold, charge VAT, but that VAT is not your own. You are supposed to give it to what? The Inland Revenue Service. So you're owing the Inland Revenue Service. So we can say VAT output or VAT what? Liability. Now your VAT input, you purchased and then you were charged VAT. So it's more like a claim that you're going to use to reduce your what? Your output. So it's more like what? An asset. Because it's a credit. Okay? So what it means is that the revenue service is now owing you. So what does that mean? You can call it VAT what? Asset. So, or VAT what? Debt. Now the debt I mean here is not that you are owing the revenue. The revenue is more like a debtor to you in this sense. Okay? So what do we now say? At the end of the day, you compare your liability with your what? Debt, or compare your output with your input, depending on what you want to use. If you're using VAT liability, and then you're using VAT what? Debt or VAT asset. At the end of the day, you compare your VAT liability with your VAT assets. Whatever you have is what you're going to remit to your what? Your Inland Revenue what? Service. Or you can say VAT output minus VAT input to get your what? What you're going to give to your Inland Revenue what? Service. So that's difference between VAT what? Output and what? VAT what? Input is what we call VAT what? Payable. That's the amount you're supposed to what? Pay to your what? Federal Inland Revenue what? Service. Although it is possible that, you know, with the way transaction flows, it's possible for you to have, you know, a further credit. What I'm saying is that your VAT input will not be higher than your VAT what? Output. So it means that the Inland Revenue Service is supposed to what? Refund you. You know, theoretically we say yes, there's a refund because they're supposed to return some cash to you, but that might not be something that is practical. You might not really be able to get that cash back, but you can now use it to offset further what? liabilities. So they will just give you tax what credit. Okay. So what I'm saying is that you must understand your VAT output, you must understand your VAT input, you must understand your what they call VATable, VAT what payable. Now there's something called VATable person. Okay, so these are the organizations that has registered with the Inland Revenue Service to what collect and charge what VAT. Now if you look at this channel, we have organizations as manufacturing organizations, we have organizations as what wholesalers, we have organizations as what as retailers. Okay, so at this point you have an accountant, he will buy, he will sell. At this point you have an accountant, he will buy, he will sell. At this point you have an accountant, he will buy, he will what sell. So when at this point now, if he buys, okay, if he buys, he's going to what be charged or he's going to pay VAT. If he sells, he's going to charge what VAT. So by the time you net the difference between the VAT output and VAT input, the VAT payable he will remit to what Inland Revenue Service. There's an accountant here as well. He will buy, he will sell. Okay, if he what sells, he will charge VAT. If he buys, he will pay VAT. At the end of the day, the difference between your VAT output and your VAT input, you know what they're going to remit to what to the Inland Revenue Service. The accountant here too, he will buy, he will sell. Okay, when he sells, he charges VAT. When he buys, he pays what VAT. At the end of the period, what he compares your output to your input to know what you're going to what give to what the what Federal Inland what Revenue Service. Okay, so based on this illustration now, so at every point here, from the tax collector's perspective, there's what a value added tax here, value added tax here, value added tax based on the value that has been what added from the what flow. So we have, let's say 0.075, okay, times times 50,000. Okay, so what do I have here? I have a 3,750 at this point. As if you apply 7.5, the VAT on this value added here. At this point too, it will be 3,750. The VAT on the value added here. At this point, it will be 3,750. So if you add this plus this and this, it will give you 11,250. Okay, that will be 11,250. So you see, at this point, what we did here, we compared the what the first purchase, okay, and what the last sales. But if we expand it, the value came in, okay, at one point, or let's say, should we say, stages at each stage of the what of the movement. So when the product moved from manufacturer to wholesaler, there was a value addition. When it moved to wholesaler to there was a value addition. When it moved to there was a value what addition. So now the value addition or the value added is what the FIR is saying tax and give us part of it. So this is what it looks like from the what tax collector's perspective. But from the accountant perspective, there's an accountant here because there are companies in manufacturing. There's an accountant because there are companies in wholesaling. There's an accountant because there are companies doing what retailing. So the accountant buys and sells, does his what output and input, net it, remit. This guy too buys and sells, does his output and input, net it, remit. This guy too does what they say. So at this each what stage there are what accountants there accounting for what their what VAT. Okay, so now you must also understand there's something called VAT drive or VAT mobilization. So that is the function of what FIRS. So they have to put structures in place to ensure that they collect the VAT from what from the respective what VATable people. So VATable people are those that the FIRS have registered to collect and what remit what VAT. So they deal in VATable products. So they can be organizations, they can be individuals, you get sole proprietors, partnerships. So they call them VAT. So VAT drive now is what we call processes put in place to ensure that they collect the VAT from what the respective what organizations or the respective people. You get, because people most like practically would gradually not want to pay. So they have to put structures in place to ensure that they collect the VAT from them. So we have to find ways to ensure that what taxpayers are responsible in remitting their what taxes. Okay, so that is a bag. Of course, I've already told you that we have what we call what do I call it? That something called zero rated and exempted products. Okay, now zero rated products are products that are VATable products, but you don't charge any amount. So it's like they are valuable products, but you charge 0%. So it means they are valuable products, you don't charge VAT, right? Now we have what they call exempted products. These are products that, okay, are not on the lists of the schedule of products that are what? That are to be charged VAT on. So what I was saying, that there are some products that you take that are not part of the list that you charge VAT on. When you deal with those products, you don't charge or pay VAT. So for instance, let's say medical products, pharmaceutical products, educational products, or materials. If you're doing this sort of product, you're not expected to charge VAT or pay VAT. Okay, so we call them exempted products and services. Okay, so you can go through your VAT Act to get the list of the list in the schedule. Okay, and then we have zero rated. Zero rated are, maybe some diplomats now, when they buy products, though they are valuable, but they charge 0%. Okay, so we want to understand what zero rated products and what exempted products mean. When you say exempt, it means it's not part of the list. But when you say zero rated, it's part of the list, but you charge 0%. Okay, so that is it with the background on what value added tax. And remember, if you are accounting for your value added tax, you must understand the double entry very well. I told you, if you have issues, you have to find a way, okay, to understand your double entry very well, so that you're able to account. So what we're saying is that, let's say there is a cash sales of, let's say, from what we did here, let's say 100,000, right? And then you charge VAT at 7.5%. Okay, that's 7,500. This is the invoice that your supplier will give to you. So you're paying. No, let's call it, this is cash purchases. Sorry. So your supplier will give you the invoice totaling what? 107,500. Like, this is what you're paying, but the actual purchases is what? 100,000. He's charging you 5%. So this is more like your input, Abi. So what do you do? What will be your double entry principle? You're going to, of course, debit your purchases, Abi, with 100 naira or 100,000 naira. Then credit your your cash with 100,000 naira, right? Is that also? And then credit your cash again. In fact, credit your cash with 107, because you're paying everything together, 107,500. Okay? Do you understand? And then what do? You now debit your your VAT input or VAT liability based on what you're using. Sorry, VAT asset. It's an asset. Okay, VAT input with 7,500. So we have debit purchases 100,000, debit VAT input or VAT asset 7,500. Okay, then you credit your cash 107,500, because this is what you're going to pay to the supplier of the product. Abi, now for that of sales. So let's say you have your cash sales, of course, is 250,000. You charge VAT at 7.5%. Abi, that's what was the VAT that we got then. 0.075 times 250,000. 18,750. So basically, you're paying 250,000 plus. So your total amount you're paying here is 2687 What this means is that you're going to it's sales, cash sales, so you're debiting your cash. What comes into your cash is 268750. 268750. So what do? You credit your sales. What's the sales value? 250,000. And then you credit your your VAT output, or VAT liability with how much? 18,750. So you have these two credits here. So when you want to remit, you compare your output with your input. The difference is what you're going to pay to inland revenue side. So what do? Okay, you're going to you can even do a provision. Okay, you can do a provision. All right. So at the end of the day, you credit your cash and then debit the respective account. Do you understand what I'm trying to say? So basically, if you look at it, you have VAT output here to 18,750. Okay, it is a credit, right? You have a debit here. So let's even do that. So we can now say, okay, because we have a VAT asset, right? What are we doing here? Here it's supposed to be debit now. So it's debit. We're debiting VAT input, abi? So there's a VAT input here of what? 750. So if you credit this guy 750, you transfer that value to here, okay, by debiting with what? 750. The balance on that account will now be how much? The what they call the 11,000. What? How much did we get there? We have what? 18,750. Okay. Minus what? 7,500. 11,250. So if you credit your what? VAT what? Input your VAT asset to close it and then debit your what? Your VAT what? Output here. You'll be having a balance there to be what? 11,250. So what do you now do? When you want to pay, you credit your cash and debit your what? Your VAT output. Okay, so that is exactly how to what? Account for value added tax from the accountant's what? Perspective. So if you have questions, you can reach my number this period. I'll get to reply with the right answers. So let's quickly take this short question. They said the following trial balance relates to that of Omo Oga Limited for the month of April 2020. So we have total expense there to be 32 million, share capital there 43 million, loan is 23,740, cash is 15,240, accumulated depreciation is what 5,500, and we have non-current asset to be what 25 million. So total debit is equal to that. We have 22,240 and 2 million. So now there's an additional information. Okay, so what is it saying here? It's saying that Omo Oga Limited buys and sells vatable products in cash. Cash sales for the month amounted to 40 million before applying VAT. Cash purchases for the month amounted to 30 million before applying VAT. Okay, then we now have depreciation charge for the month amounted to what? 458,000 naira. You're required to compute the VAT payable to FRS, prepare the revised trial balance, prepare the income statement for the month, and prepare the statement of what? Financial position for the month. So let's quickly solve this question. It's not something that we should take us time. Okay. So we're taking the question. So we have Omo Oga Limited. So let's compute the tax payable, that's VAT payable to the Federal Revenue Service now. So what do? We say VAT what? VAT output is the VAT you are charging on your sales, right? So we can say your sales according to the question is what? 40 million before VAT. So we say VAT output now will be 7.5% times what? 40 million, right? So what does that give to you? That's 3 million. That's 3 million. 0.075. 0.0075 times 40 million. So we have 3 million. Okay, that's your VAT. So VAT input, that will be 7.5 times your purchases. What you purchased before VAT? 30 million. So we now have what? We have 2,250,000. So your VAT payable will be what? The difference between this and this, okay? Which is equal to 3, 1, 2, 3, 4, 5, 6. So we have 750,000 naira. So that's it for the VAT payable. So the next one here, they say we should prepare the revised trial balance. Okay, so what do? We already have, so let's say revise what? Trial what? Balance. What do we have here? Of course, you know, we have debit, we have credit, right? Okay. But before then, you should be able to what? Raise your journals. What are the journals in this question? What are the journals in this question? Of course, you make sales, right? Cash sales. What do? Let's call it journals. So what do you have? You have debit, you have what? Credit. So let's take it in thousands. Okay, so you made sales, right? So you have cash, debit cash. Your sales will be what? 40 million, which is 40,000 there. And then, okay, credit sales there, right? Remember you charged VAT, what we call VAT output, right? So you can say VAT, or let's say cash, because you're going to collect money for that. So the VAT on it is what? 3 million, which is 3,000 here. So we have VAT what? Output or VAT liability too. That will be 3,000, right? And then the next one now we have purchases, right? So we have purchases now. What did we purchase? Purchases is what? 30 million. Okay? And then what do you have there? You're going to pay for the purchases too. That's 30 million, right? Okay. So what's the next one then? We have what again? You're going to have to charge VAT or pay VAT, which is VAT what? Input or VAT asset. Depending on what you call it. So that's what? 2,250. Right? Of course, you're going to credit cash with 2,250. So this is, you know, the journal what entry for the what the VAT element there. Okay. So at the end of the what month, when you want to what raise your what your journals to nil it off to be 750. You know we have what VAT output here, credit of what 3,000. Then we have VAT input here, debit of 2,250, right? So we can close this and bring it to this place. Okay, when we close this, let's close this. If you want to close this now, you're going to credit it and then debit this guy here. Okay, so we can close VAT input. That's when you want to pay anyway, and payment usually will be in the following month. Okay, so what do you have? We have VAT what? If you now what? If you debit this guy, no credit this guy, okay, you're going to debit VAT what? Output with how much? 2,250, and credit VAT what? Input with 2,000 what? So with this, okay, you're going to clear this, and this will come here and reduce it to what? 750. So let's prepare the trial balance now. So based on the balance here, we already have some things here. Okay, so we have total expense. That's debit of 32 million. So we have 32 million. Then we have what do we have there? Share capital. So our share capital there is how much? 43 million. 43,000. So what's the next one? Loan. Our loan there. What's the loan there? Loan there is what? 23,740. 23,740. Then what's the next one there? Cash. Cash there is what? 15,240. Okay. Accumulated depreciation. What do you have there? 5,500. Then what's the next one? Non-current assets. 25,000. Okay, so now we bring the journals in. Okay, let's bring the journals in. So we have cash here, debit. Right? So if you now open your what? Your ledger. Let's do our cash ledger here. There's an opening balance of cash here, right? Which will be what? Balance brought forward of how much? 15,240. There's a debit cash here, 40 million. So we'll say 40 million. There's another debit cash here, right? Of how much? 3,000. So we'll say 3,000. So what? There's another no debit cash here. So the next one now is credit cash. So we have credit cash here to be how much? 30,000. Because this is purchases. This is what? Sales. Right? And this is what? VAT output. So we have purchases, we have VAT input. VAT input here. Where is it? This cash here is debit. VAT output here is credit. So we're debiting. So here we have, where is it? Cash here, 2250, 2250, right? So that's, we have 1, 2, 3, 4 cash. 1, 2, 3, 4. So at the end of the day, there will be a balance here. So let's see the balance. So what's the balance now? We have 15,240 plus 40,123 plus 3,123. Okay, that's 58,240. 58,240. So 58,240. Okay, minus 30,000. Okay, minus 2250. I'm saying 25,990. So your carry down will be 25,990. So everything will be what? 58,240. So your brought down here will be what? 25,990. So this is exactly what I am trying to achieve. So with this now, it means that your cash has changed to what? 25,990. So it will no longer be 15,240, but what? 25,990. That's your cash. Okay. So what's the next one? We've done non-current asset now. We've done this now. Okay. And now our sales. Let's pick our sales. Our sales is credit, abi? That will be 40,000, 40 million. Our purchases here. We have purchases, okay? That will be how much? 30 million, right? So if we use our journals here to clear those output against input, then there will be a VAT payable for 750. So we can say VAT payable. Okay? So what's the VAT payable now? Of course, the output is more than the input, so there's a liability, abi? Of how much? 750. Okay? So with this now, you can test the revised what? Trial balance. So let's test the revised trial balance. Okay? Let's be sure that we've taken all the necessary journals in there. What about there's depreciation here? Okay, depreciation here is 4580. So that means we're going to have depreciation of what? 458. Then accumulated depreciation will be what? 458. Okay, so let's check if there's anything. You have 32,000. Okay, plus 25,990 plus 25,000. Okay, plus 30,000 plus 458. Okay, so we have 43. So that's it. Total there is what 113448. We have 113448, 113448. So that is it now for the VAT and debit side is equal to what? So from here now, we'll prepare what? They say we should prepare what now? The income. Okay, so we have what? Oga Limited. So what do we have? Sales. Okay. So what's the sales there? Let's go to trial balance there. Sales here is 40 million. So what's the cost of sales? That's your purchases. What's the purchases there? 30 million. So when you take that, what do you have? 10 million. So that's your gross what? Profit. So what's your total expense? That would be what? Total expense is 32 million plus what? Your depreciation 458. So 32,458. 32,458. So when you take that out, what do you have? 10 minus 8 is 2, 9 minus 5, 4, 9 minus 4, 5, right? 9 minus, what are we doing? Sorry, it's negative, right? This is higher than this, so 8 minus this is 8. We have 5, 4, 2, 3 minus 1, 2, right? So what do you have there? You have net profit or what? Loss. Net profit or loss. So loss is where your total expense is more than your what? Gross profit. So that is it for the what? Income statement. So now let's prepare the statement of financial position. Okay, remember this Oga. Okay. Excuse me, please. We have income statement for the month of what? April, right? Of course, the name of the business is Oga Limited, right? Yes, let's put that in. So now the next one, I will have what? Statement of what? Financial what? Position, right? As at 30th was April 2020. So let's go. So we have non-current assets. Non-current assets. So what's the non-current asset here? I think non-current asset here, based on the listing we have, where is it? 25 million. So we have 25 million, right? So what do you have? We have accumulated depreciation here will be 5,500,000 plus 458. So what do you have there? So we have 5,458, okay, plus 5,500, 5,958. So we have accumulated depreciation 5,958. So when you take that out, what do you have? I have 19,042. 19,042, right? So what are our current asset here? I think the current asset here, I can see cash, right? So what's our cash here? 25,990. We have 25,990. Okay. Is there any other thing? No other thing here, right? So when you add this, you should have something. So I have 45 markers are not 45032. Okay, so what our like this is what this is more like, let's call it total assets, right? And let's go on our liability. Our liability there, what do you have? Let's see. What do you have there? I can see loan. What's our loan there? Loan is 23,740. 23,740. So we have 23,740 for loan. So what's the next liability item there? Okay. Okay. What do you call it now? Share capital is 43 million. But remember that your profit or loss has an effect on your share capital. Okay. Your share capital here is what? 43 million, but you're having a negative reserve. So that will eat into your what? Will eat into your share capital. Okay? So of course we have share capital here. Share capital here is what? 43 million. But there's a reserve. Okay, the reserve here is negative. You know your profit. If you made a profit, you have something to what? Share to the owners of the business. But here it is negative, there's a loss. So it what? Eat up a bit of your what? Capital. Okay, so we have our reserve here negative to the what? 22,458, right? So we have 22,458, but it's negative. So let's add up. So we have 23,740 plus 43,123, okay, minus 22,458. Okay, so what else have we not touched? So we have VAT payable there. Okay, so let's go VAT payable. What's our VAT payable? What's our VAT payable? VAT payable here is 750. Okay. What's our VAT payable here? VAT payable is what? 750. So when you add up, what am I having here? 43532. Here we have okay, so we have 45032. Okay, so this is sorry about the marker and the board. I'm trying to try to put everything in one here. So what we've just done, this is just a simple statement of financial position. So the non-current asset are more like the fixed asset here. So we have 25 million from the trial balance here. And then we have accumulated depreciation. There was 155 here, and then there's one for the current month, 458. So we add it together, you have 595. So when you take that out of this, you have what you have here, 9042. Okay. And then we now have what? Current assets. The current asset here is your cash. Your cash here is 25,990. So you have 25,990. So if you add this to this, you have 45032. So your liabilities part, you have your loan. What's your loan here? 23740. Okay. Then you have your share capital for the 3 million. Your reserve, which is your loss here, is negative. Okay. So that's why you put it in bracket. So it will be this plus this minus this, then plus your what? VAT payable. Your VAT payable here is what? 750. So you put it there. 7 what? 50. Okay. So we have 750. When you add this to this minus this, you have 45032. Okay, 45032. So you can see that your total liabilities here 45032 is equal to your total assets here, which is also 45032. So this is more like your statement of financial position, comparing your what? Your asset for the period with your liability for the what? Period. So in this question, we've been able to just look at VAT implication, okay, from the accounting perspective, record them and then read our journals accordingly, and then prepare the what? Income statement and the statement of financial position. So if you have questions, you can reach me on the numbers displayed. Remember, you can support us by paying to the account displayed, or call to buy copies of material I will distribute to students for free. Classes are on jadosconsulting.com for free. No one is telling you to pay. Go there, help yourself, be an accountant that can work without supervision, okay? And then be a student as well that can have an experience of how it looks like, from an industry perspective. Thank you.